Jeff Bezos' wealth from 2007 to 2011 went from $18 billion to $18 billion. Wait, you didn't read that wrong. His wealth stayed flat, but it actually gained billions in value. So how much tax did he pay during that period? Zero, exactly $0. Elon Musk paid no income tax in 2018. Warren Buffett, despite being one of the richest people in the world, pays a lower tax rate than his own secretary. In Buffett's own words, "My tax rate is lower than my secretary's, and that is shameful." In 2021, ProPublica analyzed leaked data from the Internal Revenue Service. The result? America's richest 25 people saw their wealth increase by $401 billion between 2014 and 2018. But the total tax they paid during that period, only $13.6 billion. That means an effective tax rate of 3.4%. Meanwhile, the middle-class American loses 25-30% of their income to taxes. A nurse pays 24% tax. A teacher pays 22% tax. A driver pays 12% federal tax plus 7.65% FICA tax. How is it that the richest people in the world pay zero tax? The answer is 3 words: buy, borrow, die. Buy, borrow, die. This is not tax evasion. This is a systematic wealth transfer mechanism carved into law. And in the next 22 minutes, what I'm going to show you is exactly how this system works and why it was designed not for you, but for them. In June 2021, ProPublica published what may be the biggest financial exposure in American history. Based on confidential IRS tax records, it revealed the real tax rates of the ultra-rich. Here are the striking findings. Jeff Bezos paid no income tax in 2007. He paid none in 2011 either. His total wealth reached $99 billion during those years. But in terms of realized income, his tax liability was zero. Elon Musk paid no income tax in 2018, even as Tesla's value exploded and his wealth increased by $13.9 billion. He even received a child tax credit that year. Michael Bloomberg experienced a $22.5 billion increase in wealth in certain years, yet paid a total of $292 million in tax. That's a rate of 1.3%, less than half the rate a teacher pays. Carl Icahn added $1.2 billion to his wealth in 2016 and 2017, but received a tax refund, meaning he got money from the government. George Soros's wealth increased by $8.3 billion between 2016 and 2018. Tax paid? Zero. So how is this possible? Are these people cheating? No, they're doing something worse. They're following the law, because the laws were written for them. The first step of the billionaires' zero tax strategy: buy. But what do they buy? Stocks. And they never sell those stocks. Here's the key point. In America and most of the world, only realized income is taxed. Meaning, until you sell an asset, the increase in that asset's value is not taxed. Think about it like this. In 1997, at Amazon's IPO, you bought shares at $18 per share. Today, Amazon stock is $180. Your wealth increased tenfold. But until you sell that stock, that $162 gain is considered unrealized, and it is not taxed. Billionaires have perfected this principle. More than 90% of Jeff Bezos' wealth is in Amazon stock. Elon Musk's wealth is in Tesla and SpaceX shares. Mark Zuckerberg's wealth is in Meta shares. Larry Page and Sergey Brin's wealth is in Google shares. And none of these people take salaries. Jeff Bezos' annual salary from Amazon is $81,140. Elon Musk takes no salary from Tesla. Mark Zuckerberg's salary at Meta is $1 a year. Why? Because wages can be taxed up to 37%. But stock appreciation is not taxed until you sell. And if you never sell, you never pay tax. The genius of this strategy is this: the entire fortune sits on paper, yet it creates no tax obligation. Bezos' wealth can increase by $13 billion in a single day, but not a single cent is added to his tax bill. But there's a problem. If you never sell your stocks, how do you live? How do you buy your mansion, your yacht, your private jet? That's where the second step comes in. The billionaire's second step: borrow. But not a normal loan. This is a very special kind of borrowing. A billionaire uses their stocks as collateral and takes a loan from a bank at extremely low interest. This is called a securities-backed loan. Here's how it works. Let's say you have $10 billion worth of stock. You go to a private banking unit and say, "I'm putting these shares up as collateral. Give me a $1 billion loan at 2% interest." The bank gives you the loan because the collateral is strong. You use that $1 billion to buy a mansion in Beverly Hills, a Gulfstream jet, a super yacht. You live your luxury life. But here's the critical point. A loan is not income. In America and most of the world, borrowed money is not considered income and is not taxed. You spent $1 billion, but according to the tax authority, your income is still zero. So how do you pay back the loan? Here's the real trick. You don't. At least, not right away. 1 year later, your stocks gain 10% in value, and your portfolio goes from 10 billion to 11 billion. Now you go back to the bank and take a new loan. You use this new $1.2 billion loan to pay off the old $1 billion loan, and you have $200 million left over. This loop continues forever. You never sell stock, you never pay tax, you keep borrowing, and the appreciation of your shares covers your debts. Warren Buffett explains this strategy perfectly. I never sell my Berkshire shares, I borrow against them and live on that borrowing. But why do banks lend to billionaires at such low rates like 2%? Because those banks are controlled by giants like BlackRock or Vanguard, which are among the biggest shareholders of those billionaires' companies. The system feeds itself. The third and final step, die. And this is where the magic really begins. There is a rule in the American tax system called step up in basis. This rule says when someone dies, the cost basis of the assets they own is reset to the market value at the time of death. So like this, let S say your father bought Apple stock in 1980 at $10 per share. When he dies in 2024, Apple stock is $180. When you inherit those shares, the IRS treats it as if you bought them at $180. The $170 gain from the past is completely erased and is never taxed. This is a massive tax avoidance mechanism. Because a person multiplied their wealth throughout life, reached hundreds of billions, paid no tax, and when they die, all those accumulated gains become tax-free. According to the ProPublica report, in 2020, $41 billion in capital gains escaped taxation thanks to the step-up in basis rule. Between 2014 and 2018, the total was $160 billion. These numbers are astronomical because the ultra-rich carry assets across generations. The Rockefeller fortune was built in the 1900s and is still passed down through generations. With every generational transfer, step-up in basis kicks in and the amount escaping tax multiplies. Even more ironic, when a middle-class American dies, their heirs may have to pay estate tax. But for the ultra-rich, avoiding estate tax is extremely easy. They can reduce estate taxes to zero using family trusts, charities, and holding structures. Result, a billionaire family can transfer a fortune that grew from $1 to $100 billion from generation to generation without paying a single cent of tax on that $100 billion of gains. Buy, borrow, die. Buy, borrow, die. The system was designed for this. Now let's get to a deeper question. Do these billionaires only buy stocks? No. In the last 10 years, they've quietly been buying far more strategic assets. Bill Gates is the largest farmland owner in America, more than 242,000 acres of farmland. Why? Because food security is the most critical issue of the 21st century. Climate crisis and population growth will make food more valuable than gold. Jeff Bezos is not focused only on Amazon. He is investing billions in his space company Blue Origin. Why? Because resources on Earth are running out, and the future is in space. Elon Musk is investing not only in Tesla and SpaceX, but also in Neuralink, brain-computer interfaces. Why? Because in the age of artificial intelligence, if you can't upgrade the human brain, you fall behind. Mark Zuckerberg bought 4,400 acres of land in Hawaii and built a 6-foot wall around it. Why? Because when social collapse arrives, you'll need a safe haven. Peter Thiel obtained New Zealand citizenship and built a doomsday bunker there. Why? Because the ultra-rich know the future is full of disasters. But the most interesting investment, water rights. T. Boone Pickens, before he died, owned massive water rights in Texas. Michael Burry, the hero of The Big Short, has been investing in water rights and water companies since 2010. Why? Because by 2040, water will be more valuable than oil. Another hidden asset, disaster bonds. These are financial bonds tied to natural disasters like hurricanes and earthquakes. If no disaster happens, you earn 10-15%. If a disaster happens, you lose your money. Yet giants like BlackRock manage billions in this market. The message is clear. The ultra-rich know crises and collapses are coming, and they protect themselves with physical, real, essential assets. Meanwhile, the middle class is told, invest in stocks, fill your 401k, and in the next collapse, who will lose? Guess. Now let's go even deeper. Why do billionaires come out of every crisis richer? The answer lies in a phenomenon discovered by 18th century French economist Richard Cantillon, the Cantillon effect. When new money enters the system, the people who receive it first get richer, and the people who receive it last get poorer. Here's how it works. In a crisis, the Federal Reserve prints money. $4 trillion in 2008, $5 trillion in 2020. But where did that money go? First, to banks. Banks use that money to lend to the ultra-rich at 0.5 to 2% interest. Those rich people used it to buy stocks, real estate, companies. Asset prices exploded. The rich got richer. But by the time that money reached the middle class, Inflation had already begun. The prices of milk, bread, gas rose. Wages couldn't keep up. The middle class lost purchasing power. That's the Cantillon effect. Money creation increases inequality because the entry point of money is the rich. During the 2020 pandemic crisis, this effect broke records. The S&P 500 rose 100%. Real estate prices rose 40%. Yet, in the real economy, millions lost their jobs and small businesses collapsed. Elon Musk. US wealth went from $25 billion to $200 billion in 2020. Jeff Bezos from $75 billion to $200 billion. Meanwhile, minimum wage workers became poorer during the pandemic. The system is deliberately designed. The rich are the first stop of money, and you are the last stop. Now let's get to the real question. Why was the tax system designed like this? The answer is simple. The system was designed for the people who write the system. When the income tax system was established in America in 1913, only the richest 3% paid taxes. The system was introduced with the principle of take from the rich, give to the people. But over 100 years, the opposite happened. Today, the middle class pays the highest effective tax rate because wages are automatically withheld and there is no escape. Meanwhile, for the ultra-rich, there are hundreds of legal escape routes, offshore accounts, Cayman Islands, Switzerland, Panama trusts, wealth transfers across generations without being taxed. Charities donate 5%, control 95%. Holding structures, assets remain inside companies, personal income stays zero. Step up in basis, all gains are erased at death. And most importantly, lobbying. The ultra-rich finance the people who write tax laws. According to Open Secrets data, the finance sector spent $2.9 billion on lobbying in the 2020 election cycle. Result? Every new tax reform opens new escape routes for billionaires. The 2017 Trump tax cuts lowered the corporate tax rate from 35% to 21%. Guess who won? 55% of Fortune 500 companies paid zero tax in 2020. The system is rigged. The game is broken. And the ones who broke it are winning. Now let's look into the future. When an economic collapse arrives between 2026 and 2027, what will happen to the buy, borrow, die strategy? There are two scenarios. Scenario one, hyperinflation. If the Federal Reserve keeps printing money, the dollar loses value. In that case, billionaires' debts lose value too. If you owe $1 billion and inflation hits 50%, that debt's real value falls to $500 million. The ultra-rich erase their debts through inflation, while the middle class loses its savings. Scenario two, deflationary collapse. If asset prices collapse, stocks, real estate, billionaires' collateral loses value. Banks issue margin calls, meaning bring more collateral or sell your shares. In this scenario, some billionaires may be forced to sell shares and pay taxes. But even this scenario hurts them less than it hurts the middle class, because billionaires have backups. In both scenarios, the ultra-rich win. Why? Because in crises, assets become cheap and cash is king. Billionaires have cash and credit power. Your savings have eroded. The same thing happened in the 2008 crisis. Real estate collapsed and millions of middle-class families lost their homes. Giants like BlackRock and Blackstone bought those homes in bulk. Today, 30% of rental homes in America are owned by institutional investors. History doesn't repeat itself, but it rhymes. When the 2026 crisis arrives, the ultra-rich will become even richer. Now, the most important question, what can you do? Let's be realistic. You won't build a $10 billion stock portfolio like Jeff Bezos, but knowing how the system works gives you an advantage in protecting yourself. Here are 5 concrete strategies. Diversify asset classes. Don't rely only on stocks. Move into physical assets. Gold and silver, outside the system, physical value. Farmland, food security equals the future. Water rights, if possible. Bitcoin, decentralized money but risky. Use debt intelligently. Borrow like billionaires. Not for consumption, but for production. If you borrow, use that debt to acquire an asset, real estate, a business, so inflation works in your favor. Use tax advantages. Use tax-advantaged accounts like Roth, IRA, and 401k. Start a small business and write off legal expenses as business costs. Get financial education. The system was designed to keep you ignorant. Learn how money is created, how debt works, and how tax laws work. Knowledge is power. Hold cash during crises. Crises mean opportunity. Those who held cash in 2008 and 2020 bought assets at bottom prices. The same will happen in 2026. Prepare your cash for crises. But don't forget this. As long as the system doesn't change, the game is always the same. Billionaires win, the middle class loses. The only difference is that this time, you know the rules of the game. Buy, borrow, die. 3 words, 1 empire. This is not a tax evasion strategy. This is a systematic wealth transfer mechanism carved into law. While billionaires pay 3% tax, you pay 30%. And the gap grows every year. The ProPublica report proved it. America's richest 25 people experienced a $401 billion increase in wealth while paying only $13.6 billion in tax. That is 10 times lower than what a nurse, a teacher, or a driver pays. The system is not fair. The system is designed. And the moment you realize this design, you begin to decode the rules of the game. History teaches us this. When wealth inequality reaches a certain point, systems collapse. It happened in Rome, it happened in France, it happened in every empire. Maybe in 2026 it will happen in America too. But who will win from that collapse? The prepared, the informed, the ones who understand how the system works. In the next video, I will show you something even darker. The 7-stage collapse pattern. Rome, Britain, the Soviets. Next up, us. History doesn't repeat itself, but it rhymes. In 2026, maybe a new line in that rhyme. Subscribe to Dark Money Historian. In the comments, tell me, how are you protecting yourself against this system? Are you moving into physical assets, or are you still in stocks? Because the answers are not hidden in the future. They are stored in the past.